Hello everyone, I'm Miles. Today we're going to discuss one of the most fundamental questions in inventory accounting, which inventory costs are included in cost of goods sold, COGS, and which remain on the balance sheet. Whether you use the first in, first out, or the last in, first out method, there's an equation that always holds true. Beginning inventory plus purchases during the period equals cost of goods sold plus ending inventory. FIFO and LIFO don't change cash flow. What they change is the timing of when costs are recognized and where they appear on the financial statements. Under FIFO, the earlier costs are included in COGS, while the more recent costs remain in inventory and on the balance sheet. Under LIFO, the more recent costs are included in COGS, while the earlier costs remain in inventory and on the balance sheet. In a typical inflationary environment, LIFO results in higher COGS, lower reported profits, and lower current tax liabilities, while FIFO leads to higher reported profits and higher tax liabilities. So here's the question. Why do companies still choose LIFO even though it means reporting lower profits? The reason is that under LIFO, companies can defer the payment of cash taxes, thereby gaining the time value of money. Under US GAAP, companies that use LIFO are required to disclose the value of inventory under the FIFO method. Therefore, we define the LIFO reserve as the difference between ending inventory under FIFO and ending inventory under LIFO. The LIFO reserve not only represents the cumulative difference in inventory valuation between the two methods, but also reflects the source of deferred tax liabilities, DTL, created in an inflationary environment. There are a few key formulas that you must keep in mind during analysis. COGS under FIFO equals COGS under LIFO minus the change in the LIFO reserve. This is because the difference in COGS between FIFO and LIFO only occurs in the current period. So you must adjust using the change in the LIFO reserve for the period, not the total historical accumulated amount. Net income under FIFO equals net income under LIFO plus the change in the LIFO reserve multiplied by 1 minus the tax rate. Using these relationships, we can calculate that the tax savings from LIFO for the current period equals the change in the LIFO reserve multiplied by the tax rate. Now let's use some problems to learn by solving. Case 1. For cost flow A, the inventory purchase costs are 14, 16, 19, and 25 in order. 3 units are sold this period. Under the FIFO method, COGS equals 49 and ending inventory equals 25. Under the LIFO method, COGS equals 60 and ending inventory equals 14. The sales are exactly the same, but the financial statements are already different. Case 1, Part B, Profit and Taxes. Assume sales revenue is 120 and the tax rate is 20%. FIFO net profit equals 56.8. LIFO net profit equals 48. With LIFO, 2.2 less in taxes is paid this period. Case 1, Part C, LIFO reserve and tax savings. The LIFO reserve equals 25 minus 14, which is 11. The corresponding tax savings, that is the deferred income tax liability, is 11 times 20%, which equals 2.2. Please note, LIFO does not understate a company's performance. It simply recognizes the actual costs of the period earlier. Case 2. From an analyst perspective, converting LIFO to FIFO, the disclosed information is as follows. Ending inventory under LIFO is 4,980. Current year LIFO reserve is 1,720. Prior year LIFO reserve is 720. COGS under LIFO is 21,060, and the tax rate is 20%. Question 1. What is the ending inventory under the FIFO method? 4,980 plus 1,720 equals 6,700. Question 2. What is the change in the LIFO reserve? The change equals 1,720 minus 1,720, which is 1,000. Question 3. Under the FIFO method, COGS according to the formula is 21,060 minus 1,000, which equals 20,060. Question 4. What is the impact on profit? Under LIFO, the tax savings equal 1,000 times 20%, which is 200. So under FIFO, net profit will be 800 higher. Finally, FIFO and LIFO are not mutually exclusive truths. They are simply different perspectives for observing the same economic reality. The difference lies in when the economic facts are revealed. FIFO places more emphasis on the relevance of the balance sheet, while LIFO focuses more on the accuracy of the income statement and reflecting actual costs. The LIFO reserve is not just an accounting footnote. It's a record of time. It quietly captures inflation before cash flow appears, reshaping value in the process.